Hello everyone and welcome into the Kerrigan Market Update. We're joined now by Erin Kerrigan, Managing Director of Kerrigan Advisors. Thank you so much for joining us.
Thanks, Bridget, for having me.
All right, can you tell us how did the Kerrigan Index perform in July?
The Kerrigan Index did quite well in July. It was up over 3.8%, keeping in line with the S&P, and also for the year, it is in line with the S&P, up over 5%. We think this is quite interesting because the index continues to rise even with all of the talk of disruption in auto retail, concern about auto retail, and yet the largest companies in our industry are seeing their valuations rise. In fact, from the low that these companies hit in the beginning of 2016, they are up over 35%. We think this is really Wall Street's way of saying that there is clearly more consolidation in auto retail and that the largest companies in our industry are going to disproportionately benefit from consolidation, both through economies of scale and, of course, through economies of scope, meaning ways that they change their business model and are more nimble and have the capital to do so by investing in technology, enabling them to continue to grow earnings, even if there is some disruption to the way cars are sold in the future.
Now, the public's released earnings recently. What's your take on that?
So the earnings for the largest companies in our industry were very strong. On average, earnings were up 28% for the publics. And a lot of that was driven, of course, not by new vehicle margins, which continue to feel some pressure, but rather from incredible strength in the used car department, as well as service. Interestingly, many of them reported very strong service growth performance, including in the very valuable customer pay area. We also saw F&I per vehicle improve as well. So once again, not surprisingly, we know that so much of the gross margin in our industry is not coming really from the new car department, but rather from the other parts of the new car business, which is, of course, used, service, fixed, operations, including collision center, and then, of course, the very valuable F&I department. And that does seem to be the engine of earnings growth for 2018.
What drove the strength of the public's earnings?
One other item that we also found is that the tax rates, each of the publics mentioned that their tax rate has declined substantially with the change in the federal tax code, and that, of course, is also improving their free cash flow.
Are interest rates affecting dealership real estate?
They certainly are. It's interesting to look at how interest rates affect real estate. For one thing, of course, we always see the effect of interest rates in cap rates. As cap rates rise, typically the value of real estate declines because it's like a bond, it's a yield on the earnings from that real estate. And as the yield that investors require on the real estate goes up, the value of the asset usually goes down. Now, we haven't quite seen that yet, but where we have seen the effects of rising interest rates is, in fact, on the rent that the average dealership charges, and specifically on rent per new vehicle sold, which is currently at levels we haven't seen since the recession, over $900 per new vehicle sold. That's a pretty big nut to swallow when you see the gross margins on new vehicles declining. It's something that we think many dealers are going to be extremely focused on, their real estate, the cost of carrying that real estate, and certainly going to think very hard on whether they're going to make those image compliant investments that many of the OEMs are requiring today.
Is tariff talk affecting the buy-sell market?
So the tariffs and the talk of tariffs is quite concerning to anyone in this industry today. I think that there is unanimous vote against any form of tariff or change in tariffs on imported cars and parts. We do think, to the degree the draconian levels that are being discussed were to be implemented, we would not only see an effect, of course, in car sales, but we would see a pretty dramatic effect on the buy-sell market and dealership franchise values should this level of tariffs, the 25% plus level of tariffs, get enacted. So it is our sincere hope and maybe a little prayer that that does not happen, that we actually remain relatively in status quo, or we don't see too many tariffs implemented in our industry.
What is your outlook for the buy-sell market for the remainder of the year?
So the buy-sell market, we're going to be coming out with our Blue Sky report in this month, in August. And what we're finding is that first quarter was a little bit slow, and that sort of surprised us. But what we discovered when we dug deeper into the numbers, that there were fewer transactions, but each transaction had many more franchises included in it. So the number of franchises that traded hands in the first quarter was actually about on par with 2017, a very strong year. Coming into the second quarter was a very, very active quarter. So year to date, we're going to be at over 100 transactions in our industry, which would annualize us at over 200 transactions, keeping in line with the last 4 years where we did have over 200 transactions completed. If you think about it, what that really means is that in 5 years, we will have seen about an eighth of the dealer body trade hands, and that's a significant amount of buy sells, and we don't see that stopping anytime soon, because we do see more buyers coming into the industry really wanting to capitalize on the consolidation, tremendous consolidation we expect in auto retail, and then we do see more sellers thinking this is the right time. So the deal activity is quite robust, and buyers and sellers are seeing eye to eye today on valuations. So we do expect that to continue for the remainder of 2018.
Well, Erin, thank you so much for joining us and sharing with us the Kerrigan Market Update. We look forward to talking with you again next month.
Thank you.